The US dollar is mounting a formidable rally, fueled by surging safe haven demand amid the rapidly escalating Middle East war. Now in its fourth week, the conflict involving the US, Israel, and Iran has shifted global investor focus from economic data to pure geopolitical risk, cementing the greenback's status as the world's premier refuge currency. The dollar index has climbed to around 99.53, rebounding sharply after a brief pullback and trading near multi-month peaks. This strength marks a dramatic U-turn from earlier 2026 forecasts that anticipated multiple Federal Reserve rate cuts. Instead, skyrocketing energy prices are reigniting inflation concerns, forcing central banks to pause easing or even consider tighter policy. The conflict's escalation is the primary catalyst. What started with precise US-Israeli strikes on Iranian nuclear and military targets in late February has exploded into open warfare. Iranian missiles have hit Jerusalem and Tel Aviv, while Israeli and American forces have struck deep inside Iran, damaging key energy assets including sections of the giant South Pars gas field. In response, Iran has targeted allies' facilities in Saudi Arabia and Qatar, partially closed the Strait of Hormuz to commercial traffic, and threatened wider disruption of Gulf shipping lanes. Oil markets have reacted violently. Brent crude has surged toward $106 to $111 per barrel, with WTI near $94.98, a 50% jump since hostilities began. The Persian Gulf, which handles roughly one-fifth of global oil supply, is now a high-risk zone. Supply fears, combined with actual infrastructure damage, have delivered a classic negative supply shock to energy-importing economies. This energy shock is reshaping monetary policy outlooks. Pre-war, markets expected aggressive Fed easing in 2026. Now, with inflation risks rising, traders price in at best one modest cut far in the future, if any. Fed Chair Jerome Powell recently emphasized it is too soon to assess the full economic impact. While the Fed maintains steady rates, the ECB, Bank of England, and Bank of Japan are showing similar restraint, leaving open the possibility of holding or even raising rates to combat imported inflation. Currency crosses tell the story clearly. The euro has fallen to 1.1563, the pound to 1.3331, and the Australian dollar to both 0.7011. These economies, heavily dependent on imported energy, face the worst of the supply shock.